Before we dive in, a quick note. You might notice that certain product names in this video have been edited or dubbed. This was done after recording at the request of one of the separate account managers we work with who asked us to remove references to their trademarked name. While the terminology has been adjusted, the strategy and insights we're discussing remain the same. Throughout this video, we'll refer more generally to tax-aware long-short, separately managed accounts, or SMAs. You're using leverage, yes, but you're not amplifying market movements. Instead, you're creating conditions that allow the portfolio to grow with the market while harvesting significant losses for tax purposes along the way, and all without adding unnecessary risk or volatility. Hi there, I'm Hilary Hendershott, CFP and founder of Hendershott Wealth Management. And this is video 2 in a 7-part mini-series about how tools you've been taught to fear, like leverage, short selling, and active trading, come together safely in the tax-aware long-short strategy we implement to create tax alpha. That's higher net returns that don't come from investment performance. They come from smart tax strategy. As we progress through this series, we'll dive deeper specifically into the tax-aware long-short strategy in our ultra-tax efficient wealth management suite of services. In many cases I see, tax-aware long-short is the most powerful tool for minimizing capital gains taxes. We've seen how it can turn a $9 million IPO windfall into $20 million over time by completely eliminating the tax bill today and leveraging compound returns instead of running out of money at age 65. How it can allow mature investors to save $1.6 million in taxes during retirement and direct that money to their kids rather than the IRS, and so much more. In our last video, we talked about the basics of leverage, how using borrowed money can either help you build wealth or backfire if the risk isn't managed well. The gist? You need to follow the 2 cardinal rules of leverage to keep it low risk. Borrow prudently and use the money to do new things, not double down on your existing investments. Now I want to introduce you to a very specific kind of leverage employed in the tax-aware long-short strategy we use, called market-neutral, tax-aware, long-short. That's a lot of words. I am going to explain them all clearly, and this will all be very digestible. The core idea? You can use leverage to buy additional stocks without increasing your exposure to stock market risk. In fact, you can use it to achieve that tax alpha I mentioned, where you earn higher net returns that don't come from investment performance, but rather from smart tax strategy, which is exactly what tax-aware long-short does for you. Not all leverage is created equally, and today I'm going to show you why. Let's start at the top. Like we discussed earlier in the series, leverage usually means using borrowed capital in the hopes of increasing returns. Most people think leverage means more risk, and they're right when leverage is used in the usual way. But market-neutral leverage works differently to keep the added risk tolerable, and depending on your overall strategy, it can even reduce risk. Market-neutral means you're not using that leverage to bet on whether the market goes up or down. You've removed that exposure entirely. In the tax-aware long-short strategy we're describing here, your core portfolio is used as collateral to borrow stocks. Then the account manager opens 2 sets of positions in a separately managed account. Long positions that benefit if the stocks go up, and short positions that benefit if the stocks go down. Because you're long and short in roughly equal amounts, the market risk cancels out. And that's the key. Leverage is primarily used here to generate tax outcomes, not to chase performance. That's what makes it market neutral. Your portfolio doesn't become more sensitive to market swings. Instead, it generates activity and losses that can be used to lower your tax bill without changing your overall market exposure or resulting in real-world losses. You really can have profits from your investments with losses only on your tax return. Let's break market-neutral leverage down into its components, first looking at the long part of the long-short strategy. This part of the strategy looks and feels a lot like a traditional investment portfolio. When you hold a stock long, you own it and earn returns when the market goes up. That's the normal way to own a stock. In a long overlay, you use your core portfolio as collateral to borrow money from a custodian like Schwab or Fidelity and buy even more of those stocks. That increases the size of your portfolio, and with it, your exposure to market gains and losses. When the market goes up, the long overlay rises with the market. In fact, it's designed to slightly outperform the broad market, and you, the investor, reap profits which remain unrealized, meaning unsold. When the market goes down, the long overlay falls in value. Here, the losses are harvested to provide tax benefits without affecting the core portfolio. It's like doubling down on your investment. And it's probably sounding a lot like that high-risk leverage we warned you against earlier in this series. But in this case, you're doubling down on the upside and simultaneously neutralizing the new added risk. You neutralize the new risk with the short overlay, which I'll tell you about next. The short overlay cancels out the extra risk from those new borrowed long positions. Now for the short side. This is where the real magic happens, where the strategy gets smarter and the most valuable tax efficiency shows up. Along with the long overlay, the manager borrows stocks to short them. That means they sell those stocks with the intention of buying them back later, ideally at a lower price. If that happens, the difference is profit. Profit that offsets losses elsewhere in your portfolio when the market goes down. However, because short positions tend to lose money over time, by design, because the stock market tends to go up over time, that's where we experience the real tax alpha magic. Those losers generate large, consistent tax losses that we can harvest and use to reduce your tax bill. So we are systematically shorting to keep those long positions we bought with borrowed money from adding market risk to your portfolio. Also, the system is designed to find stocks that statistically underperform. That's one of the ways the strategy is designed to produce a small bonus return. This is how we can intentionally create tax losses even when markets and your account values are up. So now you've got your core portfolio along with an overlay with two parts, consisting of long positions that profit when the market rises and produce harvestable losses when the market falls, and short positions that profit when the market falls and produce large, consistent, harvestable tax losses to reduce your tax bill when the market rises. The combination is what's called a long-short overlay. Even though we're borrowing to make these purchases, the positions are systematic, diversified, and balanced. We're not making big bets or trying to outguess or time the market. But in any market-neutral investment, you are making a small bet that the long positions outperform the short positions. That small bet is the opportunity and the risk. If they do, your portfolio makes a little more money. Of course, in a diversified portfolio with hundreds of stocks, this is a small bet with small risk. The goal here is to capture small, steady returns without disrupting your core investments, all while getting significant tax benefits. And no matter what happens in the market, this overlay gives you tax losses without comparable portfolio losses. We've truly never seen a strategy be able to produce tax alpha like tax-aware long-short. And it does it in both the long and short overlay, no matter which way the market moves. Let's walk through that one more time. With tax-aware long-short working for you, when the stock market goes up in value, the long overlay rises with the market. Again, it's actually designed to slightly outperform the broad market, and you, the investor, reap profits which remain unrealized. When the shorted stocks rise in value, the short overlay produces losses which roughly offset the gains in the long overlay. These losses are realized, creating tax benefits without portfolio losses. And with tax-aware long-short, when the stock market goes down in value, the short overlay increases in value, and you, the investor, reap profits, which are largely deferred. The long overlay falls in value, and these losses are harvested to provide tax benefits. again, without portfolio losses. This is all facilitated by an account manager in a separately managed account. This isn't a strategy you should try to implement on your own. I know leverage and short selling sound risky, and in many contexts they are. But here's why this strategy is different. It's market neutral, so we're not betting on where the market is headed. It's rules based, so trades are driven by data, not guesses or emotion. It's highly diversified with hundreds, sometimes thousands of positions across sectors. And it's monitored and managed with ongoing oversight from investment managers. When done thoughtfully, these long and short positions balance each other out. Your leverage isn't funding bets that the market will go up or down. Instead, it's positioned to be market neutral and provide tax benefits in any case. You're using leverage, yes, but you're not amplifying market movements. Instead, you're creating conditions that allow the portfolio to grow with the market while harvesting significant losses for tax purposes along the way, and all without adding unnecessary risk or volatility. Again, this is called market neutral leverage, and it's a key component of tax-aware long-short strategy that we offer in our ultra tax-efficient wealth management suite of services. We did extensive due diligence before incorporating this into our services because we're fiduciaries. That means we're legally and morally obligated to act in your best interest. We don't roll out new tools lightly, but this methodology passed our evaluation with flying colors, and we've seen how it delivers meaningful and significant tax alpha. We've seen how it can allow clients to afford their dream beach house and keep their retirement fully funded at the same time after selling their business for $12 million, instead of slicing off a generous portion of their sale proceeds for capital gain taxes. We've seen how it can help a client diversify $12 million in Apple stock into a diversified, high-quality portfolio in less than 2 years without the $4 million tax bill. And we've seen how it can increase our clients' wealth by 30 to 50%, just by them rightfully keeping the money they worked hard to earn instead of handing it over to Uncle Sam. Because we know that for our clients, balancing risk and reward, it isn't just about numbers. It's about peace of mind. You deserve to sleep well at night knowing your investment and tax strategy is helping you not just manage your wealth, but maximize it. Let's bring this home. We've explained the long-short overlay. In the overlay, we're not trying to outguess the market or swing for the fences. We're pairing thoughtful long positions with purpose-built short positions to, first, have you benefit from market growth. Second, harvest tax losses without suffering corresponding portfolio losses. And third, give you freedom to decide when and how much tax you pay on your investments. This is market neutral leverage, and it's leverage done right. It's not flashy, risky, or speculative. It's conservative, managed, and integrated into your broader financial plan. And when it's done well, it helps you grow your wealth and pay significantly less in taxes without increasing your risk exposure. If you're investing for the long term, preserving capital and minimizing taxes works far better than chasing high-risk returns. And for suitable investors, the long-short overlay strategy is designed to do exactly that. So the next time you hear leverage, don't just assume high risk. Ask, what kind of leverage? For what purpose? And how is risk being managed? Because in the hands of the right advisor, market neutral leverage can become a tax-efficient growth engine, not a danger zone. If you're a suitable investor, that is, if you're a high net worth investor with $1.25 million or more in taxable assets, and you're tired of watching taxes eat into your gains, this is worth exploring. To understand whether this tax-aware long-short strategy and other services within our ultra tax-efficient wealth management suite might fit into your plan, head to hendershottwealth.com/contact to book a complimentary discover call with one of our lead advisors. We'll get to know your financial goals and your current tax picture. And if we're the right team to help reduce your tax drag and protect your wealth, we'll walk you through the next step. And if we're not, we'll refer you to someone who is. We're here to make sure you grow wealth wisely, efficiently, and with eyes wide open. Next up in this video series, I'll show you how this strategy works using some everyday examples like farming, cooking, and driving a car downhill. Trust me, it's about to click.